charge, but open versus closed weight is really where crypto comes in. I've been thinking a lot about this lately, and if you look what AI is doing, it's really disrupted Web2. And I'd say even Google, we're showing this in Google right now, as they're having to double down and change their CapEx and everything else. We had SaaSpocalypse, right? And the one thing that the light bulb hasn't gone out on yet, and this really plays into the open versus closed debate. And you saw the all-in guys, bantering about crypto versus AI, AI versus crypto. I've got news for everybody. AI and crypto go hand in hand. If there's one technology that will be powered by AI, it's crypto. And I think the ethos of open weights is starting to play in. We published a piece, Sandy Call, my colleague, published a piece this week around the rise of the agentic economy and how it's really happening. Whereas SaaS was disrupted by AI, crypto is going to be empowered by AI once we get through some of these security issues, which are getting solved.
What's good for the public are open weights, right? The world needs more low-cost, abundant intelligence, low-cost, abundant energy, low-cost, abundant robots and care and labor. So that's what open weights delivers. If you are Anthropic or you're OpenAI or you've got a proprietary model, then you live in a closed weight world and you want to extract rents from that proprietary IP. That's their natural incentive, and they're entitled to do so under capitalism. Now, capitalism has distillation as a part of our core feature, right? The Wright brothers created the airplane in 1905. A decade later, new companies, high growth companies like Boeing and Lockheed Martin were formed, distilled the Wright brothers IP and created these new planes and form factors. Wright brothers did not benefit from that. That's just called competition and capitalism. So let the market play out. Let's see how it evolves. I hope that we do see successful open models. I also hope that the closed model framework can win too, because they can then raise capital and fund more R&D. So let the market do what it does best.
You've got probably an even easier way to do it today, Steve, than we've ever had. You can use inverse ETFs versus the S&P 500, unlevered, twice levered. That makes sense. So yeah. My advice to everyone listening is this. Believe me when I tell you, I've made every mistake you could ever want to make in 30 years of managing money. And I've made them with a lot of zeros. I don't care which way you trade. I don't care which vehicle you use. Do this for yourself. Stop loss. Good till cancel. And if you don't know what that means, then you shouldn't be trading. That's like buying a stock or taking a position and not using a stop loss order. It's like driving a car without brakes. And I'm pretty confident you wouldn't do that. So if you don't understand that, learn it. Use them. Protecting your capital. You need your capital to continue to trade. And if it's taken away and a levered ETF can take it away quickly, you're in trouble. To the listeners, anyone can listen to an earnings call from a public company. Go to their investor relations website, click on the webcast and listen, right? Read the transcript if you want. On every earnings call already this year, and this has been this quarter, but this has been true for probably the last 12 months. Every company talks about how they're using AI in their business, whether it's to improve efficiency, productivity, ultimately profitability, to make things faster and better for their customers, to improve their service levels. We've heard that for a year. I hear that in every single earnings call. So this is not going away. The use case is tangible. And now you've got large public companies talking about, hey, we're not just thinking about this, we're using it. And oh, by the way, we can demonstrate improvements in efficacy by a whole host of measures. But what we really look for is, has that improved, operating income? And so we're starting to hear that. Now, I think Microsoft did a really good job last night and their call, Meta didn't. We'll see what Amazon and Apple say tonight, right? But we're probably in the second inning of the game. The risk is there that the whole thing is a bunch of BS and it falls apart. We do not believe that. We do not believe that. We think we're in the second inning of a 9-inning game and this is real. Now, that's okay conceptually. That might not line up to making money in the stocks, which is a completely different game.
For example, if you ever watch a TV show, something like a Blacklist, and the context in which Bitcoin comes around is generally some criminals asking another person for ransom. And every time I watch something like that, I'm like, what are you doing? That is way more traceable than cash. It makes absolutely no sense. And so it's this deep sort of belief that you think, oh, it's cryptographic money. Obviously, it must be private, right? And so it's not even really understood that actually, no, it is traceable digital gold as the official Bitcoin account, which I'm not even sure who owns that, on Twitter literally says in their bio, right? And there's all sorts of supporting anecdotes here. So for example, when Hal Finney was alive, he would tweet about wanting to add anonymity to Bitcoin. And you can see the early Bitcoin forums where Satoshi himself says something like, if this was possible, referring to using ZK, this would make for a better, more efficient implementation of Bitcoin, but I don't know how to solve the double spend problem. And naturally, that was because ZK was super early in its, Zcash didn't exist. There was no production deployment of ZK snarks at that time.
Perhaps another way to say everybody as well is when you start to understand like the costs of compliance around KYC and AML, or more broadly, like follow the money methods, right? And I think that when we start implementing these kind of tools, it's going to require smarter approaches to those regulatory challenges. But the reason why I say that is because those compliance costs, they don't get paid by like a bank. That gets paid down to the individuals, right? Like the general public. And the main sort of perpetrators or people who benefit from avoiding KYC are typically the sort of political and financial elites, right? And they don't need the privacy in the same way they do because they're effectively writing the rules. So there's a power issue here. And like this kind of goes back to the sort of cypherpunk motto, you know, privacy for the weak and transparency for the powerful. So I think that our public institutions should be, you know, public and everyone else should be able to selectively reveal themselves.
A lot of people don't really understand how open source works. And I'm not saying I am the total expert here, but essentially, like, it allows you to download it onto a machine and then you can change it on there. And so there's technically no centralized entity. But what happened is that you're leveraging, like, a lot of these open source models, they make money based on APIs, assuming that people aren't going to fully host it locally. And how you look at how people use open source versus closed source, it's not one or the other. Like, they're using things for different things. So there's also a problem there, but I don't know if a ban is going to solve that, especially because, like, oh, this is another weird fact. So Hugging Face used the open source model to figure out what was happening. And it's unclear from the background about whether, like, they realized it was OpenAI or OpenAI came and told them it was them. It's unclear. But in the future, if someone's using an open source model, you are not going to be able to tell who it comes from. So then you're sort of screwed.
Commissioner Peirce released a statement last week about vault and on-chain lending that I think is actually one of the more important crypto statements we've seen from her in a while. So I've seen a lot of takes on what this statement was trying to do, but I personally read it as like a warning shot, but also collaborative, right? She's basically saying, look, come in and talk to us because these things do raise regulatory questions and we want to better understand whether and how they may come within the SEC's regulatory perimeter. Salman, how did you read it?
Yeah, I agree with you. And I think one of the key call outs is for those of us in the industry to just come in and, you know, help educate the crypto task force and the SEC staff in terms of the Vault ecosystem. And I really break that down into the, you know, what I'll call the Vault supply chain. So both Vita and Plume are developers of Vault protocols, or, you know, on our side, it's the Nest protocol.
So it ended up being the bridge for this PerpStacks AFX. The outflows specifically were coming from this bridge. This PerpStacks AFX has like existed for like a month and a half. I think we've attributed this one actually at this point. This one's the same guys that did Layer 0.
Wow.
Like exactly the same guys.
But so it's five compromised hot validator signing keys? 5?
Yeah. Well, you know, you can have more than one key per server.
Right.
But yeah, I mean, it is a Hyperliquid style bridge situation. We also saw them like on the Hyper Unit bridge though. So I got to learn a lot about bridges because I was like, ooh, who are they targeting next? Basically, if you're in crypto, you're going to be targeted. This is the big DPRK guys, the same guys that got helped down. They're quite good at what they do. Even if you have them on separate servers, they can still get them. But they've been doing this since Ronin. These are the same guys that hacked Ronin, right? They're very good at getting on these servers and then being like, I found all your keys.
Your token project, so much of what you're trying to do is attention based, and, you know, if people buy the token, that almost works in lieu of having revenue or sustainability or whatever. And so if a bunch of people like you and they hold the token and they buy the token, then you know, that's your lifeblood. And so token projects tend to be things that either go long-term zombie, right? Or like they burn through all their cash and then they kind of disappear, they grind to zero, and then eventually they shut down, or like the labs entity shuts down when there's like nothing left. And to your point, Tay, like people are like, oh, I thought that they were dead. I think like whenever there's a tokenized project that announces a shutdown, it seems like the reaction is always so much worse. Like people are so angry. They like start dredging up all the mistakes that were made.
Heads up, everyone. We've Now fully transitioned Bits and Bips to its new dedicated channels. So if you're not yet subscribed to the new Bits and Bips channels on X, YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts, go there and subscribe now. For the next few weeks, we'll play segments of the full interviews on Unchained as a reminder, but for now, you'll only hear those short segments of Bits and Bips on Unchained. No more full episodes. You can get links to all of the dedicated channels with the full episodes at unchainedcrypto.com/bits and bips, spelled BIPS. Thanks again. Before we dive back in, a quick
Hey everyone, welcome to Bits and Bips, where we explore how crypto and macro collide one basis point at a time. We're here to discuss the latest stories in the worlds of crypto and macro, and as a quick heads up before we dive in, remember, Bits and Bips has its own channel now, separate from Unchained. So if you're not subscribed here, you're going to stop seeing the episodes. Don't lose your dose of the sharpest takes in crypto. We're on X, YouTube, Spotify, Apple Podcasts, really wherever you're watching. And before we begin, a quick commercial break.
This episode is brought to you by Cape, America's privacy-first mobile carrier. Same premium service you'd expect from any other carrier, but designed so your number, your location, and your data actually stay yours. Get 33% off 6 months at cape.co/unchained. Not listening to Bits and Bips yet? It's our weekly crypto and macro market show with Ahluwalia, Austin Campbell, and Chris Perkins. Search Bits and Bips and subscribe.
All right, everybody, welcome back. So a quick market snapshot. Bitcoin has been trading around the 63K-ish level today. ETH around the 1850s. 10-year is still hanging around like 4.72 to 4.75. Not ideal. The FOMC hike odds are elevated above 50% right now. And here to discuss all of this today, I'm your host, Austin Campbell, as always, with my co-hosts, Ram Ahluwalia, Maester of Wealth, leader of Lumina, Chris Perkins, the golden hand of Franklin Crypto. And joining us today is Alex Thorn, head of research at Galaxy Digital, who has been tracking the Coldcard exploit in real time. And by the way, if you're not listening to Galaxy Brains with Alex, you need to be. Galaxy Brains is a leading indicator of quality crypto content. All right, let's start with one of the two big stories of the day, which is the Aschenbrenner blowup. So the biggest AI fund of this cycle blew up in basically a single month. The situational awareness fell from about 45 billion to roughly 10 billion after steep July losses, all numbers approximate according to Bloomberg. Margin calls from prime brokers forced a distressed sale of its public stock portfolio to Ken Griffin's Citadel. And what remains is the Anthropic stake and private vehicle instruments for the fund, according to TechCrunch. This is a 67% drop, and AUM drop is 35 billion. Again, hard to know how much of that is allocated where, thanks to the deleveraging. But what happened is both legs of this trade broke at once. The AI infrastructure trade, SanDisk way down, Nebius way down, Micron way down, CoreWeave way down. If you're 4x levered, you don't need a crash, you need a bad month, according to Chartelect. There's a spicy claim that Citadel timed it, that Shea Ballor said Ken Griffin's Citadel was pushing surprise rate hike fears just days before the AI trade collapsed and forced the 4x levered situational awareness to unload its book near the lows. On the other hand, Scott Melker said it's leverage, not conspiracy. If you believe that Citadel intentionally crashed the market, then I have a bridge to sell you on Mars. Citadel had the dry power to take advantage of the situation. That's it. So I kind of want to start here before we go further into this. Ram, you've talked a lot about momentum. You've talked a lot about the current dynamics of the stock market. This has played into some of your previous themes. So what do you think happened here?
Yeah, I don't think Citadel did anything nefarious here. when Micron reported, the stock sold off double-digit percentage points. That same thing happened last quarter when Micron reported. Momentum was 3 standard deviations bid that came undone. We saw tremendous volatility in the South Korean stock market, and Leopold, the PM, was just drinking his Kool-Aid way too much. It actually reminds me of the blowup of Asymmetric, which was long Solana and short ETH. Those are like the same trade on leverage. Very similar kind of concept. He's a young 24-year-old kid. I don't think people should exclude him from the industry. I mean, he's learned and he's accomplished quite a bit here. But that kind of positioning is reckless, though. Like, that's not a good portfolio. Basic stress testing capabilities would have identified this. Like, where were the adults in the room? Where was the AI-based stress testing and scenario analysis? I think he's also just too close to Silicon Valley. You know, his now new wife was the chief of staff, or is the chief of staff at Anthropic. So he's so close to it, he can't see outside the AI bubble. The LPs in this got hurt a lot. It seems to be the case that the year-to-date gain comes almost exclusively from the Anthropic position. If you mark that to market, that's not much of a gain. You know, publicly listed closed-end funds that contain Anthropic are trading at discounts to par value of double digits. So a major blow up, and a lot of the new money, I would speculate here, came in the last 3 months, because that's what happens. People subscribed when the money goes up, and those liquid positions were novated to Citadel on a margin call on a distress basis. So they probably lost their principal on that liquid book. And that new money didn't get the benefit from Anthropic. So imagine this. Imagine in June, you get a month-end statement saying you're up a gazillion percent. I guess it was like 200%, some large number. You're looking forward to the wedding invitation. And of course, he's invited all his LPs to the wedding. It's a big celebratory moment. And now everyone shows up a week before they got a liquidation notice, and they're saying, can you please contribute to our next fund? And we're going to have a breakout session to talk about the future of AI. I mean, there's so many angles to the story too, by the way. The seed investors were the Stripe, the Collision brothers, $200 million they put into this, Daniel Gross and others. So just a fascinating story, lessons learned all around.
So one of the things that I have looked at in these situations is you've got to look at the price dynamics and the underlying market fundamentals differently from each other to figure out where things go from here, right? One move, we saw this with Archegos in the past, is you have something levered that blows up and it still continues functioning. The market is fine. It's just somebody levered got carried out on a stretcher. These things happen. On the other hand, you could have situations where the underlying market itself is breaking down. I don't need to tell anybody here stories about 2008 and where leverage collapsing ended up there. So, Alex, I know you guys have some involvement in this space. Can I ask you, among things you're allowed to talk about, what are you fundamentally seeing in AI world right now, data center land, all of those sorts of things?
Yeah, I would call this like maybe 20% technical. 80% technical and 20% fundamental. You have to think some of the, it's not just the recent, unwind or whatever we want to call it, what's happening in the memory and data center trade the last month or so. Also, what happened on the run up was probably a lot to do with situational awareness as well. They own percentages of like every major public equity involved in this. But if you look at the big four hyperscalers, they're still guiding big CapEx spend growth. Even if the growth rate is moderating, I think we still see substantial demand for new AI build out, which is, important for everyone and all of our portfolios, but also I think very clearly now, especially with the increase in cyber needs for AI, I really don't think we're close to the supply hitting the demand for compute and for data centers. We may be sort of in the end of the second inning or so. And so a little bit of a pause and, a brief reprice, I think makes some sense. I mean, if you recall, just think about how far we've come since just last December, I think a lot of people left and went on sort of holiday vacation, found out about coding agents literally like the last week of December. I know I basically did, although I'd been using Chat and Claude for, research and writing a little bit for at least a year before that. Came back in January. By February, people are coding. By, the spring, we're in a full-on panic / euphoria about the impact that AI will have. Now you've got frontier models like Mythos that are blocked by the government, but you've also got open source models like Kimi and GLM that are almost as good and everyone is using. So I think we've still just scratched the surface. And from the energy and compute build out side, it's hard to know. You're gonna see. It reminds me of the internet bubble. It also reminds me of some of crypto, like from 2016, right? People said 2017 was blow off top. Today we're 3+X higher than the 2017 top in Bitcoin. And the internet, well, like that exuberance was real earlier this year on AI, but we haven't actually gotten to a steady state that we think is coming. I think there's a lot more demand. And again, if you look at the big hyperscalers, like they're not balking an eye here on the demand that they see and the money they need to spend on this build out.
100%. I'll chime in. This is a young market. We're not entirely sure how things are going to level out. It's super early. And when you have something so early, volatility is very much to be expected. And when you pour leverage on top of volatility, which works in both directions, I don't want to say it's not surprising, but it's kind of not surprising that you have the outcome here with situational awareness. And all of us have gray hair because we spent years on Wall Street and like blow up after blow up. What do? You go back to your stresses, you go back to your VARs, you calibrate your risk. If you come into this as a 24-year-old with a background in tech, you hope that you surround yourself with some of those gray hairs who have that experience in risk management. Maybe that was a gap that will be expected. I think the thesis is directionally correct, but it's early and super volatile. I think it's going to get more volatile. I mean, experts are projecting that we're going to have AGI as early as 2030. Do you not think there's going to be massive volatility leading up to that and after that? It's going to happen. So lesson learned, it's not the first, not the last. It'll happen again and again.
How wild is it that he took on leverage like a degen and everyone had this halo effect around him and we're just shoveling money to subscribe. They thought he was the Oracle and he was doing what the South Koreans are doing. Actually, even more so.
Well, even, when we used to have credit reviews and you had this massively outsized performance, that was actually always a red flag to them because they're like, well, wait a second, where's this upward volatility coming from? And so I think that is also a lesson to be learned. What comes up can go down and what goes down can come up, particularly in crypto, particularly in this early AI space, particularly as we're getting into quantum. So nature of the beast with these early frontier markets.
I think another lesson here is that AI is not going to disrupt investing anytime soon. I've no doubt that he was using Claude Cowork to review positions and do analysis. That clearly did not work out. It turns out having a risk model built by an institution like MSCI, Barra, or Axioma, where you can measure your betas and your factor exposures and industry exposures and do stress tests, which has been around for decades, right? Managing variance at risk, CVAR. He didn't do that. That still matters.
I think, AI certainly can improve a lot of the risk management by honing your stresses and on things like that and looking at data series. I think, there's definitely value add. You say disrupt, I don't know, is it disrupt or evolution? Definitely changing asset management as we know it.
Absolutely. Yeah.
So one thing I would also notice here is this has been a trend of things when Silicon Valley gets really focused on itself. This is not the first time we've seen a large tech bubble of some sort come out in part or in whole. Same thing happened in 2000. And what's fascinating about it, to actually echo points all of you are making, is it's not that the internet thesis was wrong in direction, it's that it was wrong on timing. right? You price all of the gains in immediately and you allocate them to the wrong players. So, Ram, I want to push on one other thing here as we're seeing this. Like, Leopold was clearly making directional bets on a specific subset of this space. Do you, as an investor right now, have high confidence that 5 to 10 years forward, you know where the gains in AI are coming out in the market?
Well, I would say the AI adoption story is real. The productivity gains are there. You see return on invested capital from the hyperscalers. It's a legitimate story. So that one of the ironies is that Leopold's fundamental thesis is actually correct. He actually has the right big picture view. You just had terrible everything else, like, as we discussed, risk management and leverage. The names, though, I don't know, like the moves you saw in the market from March to June were truly extreme. These were less than 1% movement. And now we know why. It was the Scooby-Doo moment. Someone pulled the mask off. You say, oh, it's Leopold. Like, so he was bidding up names that really didn't make sense. Like AMD did a double, even though it's got half the margin, half the earnings growth, and twice the valuation of NVIDIA. They were very strange moves at the factor level my team and I were looking at. And now it all makes sense. That's what he was bidding up. And he was also selling off software. Now that had a vicious rally, of course. So truly extraordinary. I think one other take here is the lender of last resort is Citadel and Jane Street. So when long-term capital management blew up, the investment banks were invited down to the New York Fed by the regulators, and they said, okay, how do we pass the hat around and auction off slices of this portfolio? That didn't happen here. They called up Citadel, Jane Street, and Millennium. These firms are now the lenders of last resort. And their impact on markets is more significant than ever.
For sure. But like, I'll also tell you that Griffin is a very sophisticated, shrewd investor. Like, look what he did after Enron. He got in a plane and he picked out the value out of that company immediately. He's not doing anything for charity. He's looking at these guys saying, I have a value opportunity. I'm scooping up what I'm going to scoop up, which kind of reinforces what you said, Ram. He probably agrees with you that Leopold is directionally correct. And now he's getting these assets at a discount.
He's already up a couple $2 billion in that transaction. Yeah. It's like Citadel wins again. And I think the other thing about this, hubris is another part of the story. I saw some comments that in 10 years, Leopold will come back and disrupt Citadel. No, that's not going to happen. There's so much compounding of expertise, systems, latency, capital, know-how, risk infrastructure, human capital. They have interns that are earning a couple $100,000 a year. Like, no, you're not going to disrupt Citadel. Ken Griffin and Jane Street, they're very skillful at what they do.
And he has the Constitution too, right?
Yes.
You got the Constitution from us crypto people.
I was going to say, and like some sort of dinosaur skeleton, I believe. Like, Ken Griffin, in many ways, if you look at the artifacts that he's accumulating, is either going to be starting a museum or is a Bond villain. And there's kind of no middle ground between these two outcomes.
What about autism here, right? FTX, SBF had some fraud issues, but don't give money to autists, right?
I don't know. It did pretty well with Elon Musk, man, right? Like, if you were early in a lot of his stuff, it did pretty well.
Like I guess if you run quantitative strategies, then it works, because then you're an autist at Two Sigma and Jane Street and Citadel. Give those autists money. But discretionary autists, no, they whole hog the position. They get to a conclusion. They can't let go of it.
It's the wrong kind of non-neurotypical, right, Ron? Right. You want to give your trading money to psychopaths. All right. So before we go down this rabbit hole any further, why don't we do our second ad break quickly, and we'll be right back to talk Coldcard.
If you hold crypto on your phone, your biggest vulnerability isn't your wallet. It's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again, and SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2 middle-to-end encrypted secondary numbers for banking and signups, so you stop handing your real number to every app that asks. Go to cape.co/unchained and use code UNCHAINED for 33% off your first 6 months. Heads up everyone, we've now fully transitioned Bits and Bips to its new dedicated channels. So if you're not yet subscribed to the new Bits and Bips channels on X, YouTube, Spotify, Apple Podcasts, or wherever you get your podcasts, go there and subscribe now. For the next few weeks, we'll play segments of the full interviews on Unchained as a reminder, but for now, you'll only hear those short segments of Bits and Bips on Unchained, no more full episodes. You can get links to all of the dedicated channels with the full episodes at unchainedcrypto.com/bits and bips, spelled BIPS. Thanks again.
All right, everybody, welcome back. It brings me absolutely no joy to introduce our next segment, which is Coldcard and self-custody. So Coldcard was a hardware wallet largely marketed in some places as the gold standard in the Bitcoin ecosystem, and it had a deep systemic flaw. So an exploit tied to entropy, aka key generation, Coldcard Mark III, Mark IV, Mark V, had Bitcoin drained from, I believe, well over 1,000 wallets at this point, and the reported total has been climbing throughout the week, up, 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 up. CZ via Zero Hedge said nothing is 100%, warning Bitcoin holders after the exploit. We also have an expert who's been commenting on it extensively here, Alex Thorn, who, Alex, I saw in Cointelegraph, you said a 4th organized wave is likely in progress. 208 transactions across some specific blocks, sweeping about 389 Bitcoin from 462 suspected victim addresses in roughly 2.5 hours. Human cost is real here. Good example, the retail bull had said, I've had all my Bitcoin stolen while away on holiday. It was on a Coldcard Mark III. I was led to believe this was really secure. The 2 Bitcoin was supposed to be to give to my 2 children to give them a good start to life. And the ETF crowd has been speaking up here. Eric Balanchunas said such an intermediary upgrade for Bitcoin, safer, more secure, and almost always cheaper. Speaking about ETFs, 33-year-old industry, 15 trillion in AUM, and never once lost someone's money. So I could go on and on about this, but Alex, you've been observing the whole thing. Could you start by telling us, like, the core of how did people get this wrong? Why was all this money sitting out there in a way that it could be stolen?
Yeah, it's been a brutal 4 days. This sort of started early in the morning, Thursday UTC time, and is still ongoing. So before I even go, if any viewer or listener has funds on a Coldcard in a single signature address, as in not part of a multi-sig quorum, you should move those coins off as soon as possible. And by the way, I like Eric Balchunas quite a lot, but obviously an ETF holding a DTC registered stock inside it is not the same thing as one that holds a digital bearer asset. But we move on. The saddest part is that, to your direct question, Austin, these people did nothing wrong. In fact, they did everything right. And the Coldcard itself is very popular among a cultural demographic in Bitcoin that believes in cold storage, self-custody, stacking sats, working hard. Not that anyone deserves to have their money stolen, but this isn't a drain of a DeFi bridge where you were, bridging between, Ethereum L2s to harvest, altcoin inflation yield, right? This is not people speculating on crypto exchanges on meme coins, right? These are people, by and large, and I can tell you, I know this community quite well, that are working hard and saving and stacking sats and then putting them away for a long period of time. The average dormancy of coins that has been siphons like almost 4 years. So these are not like short-term holders. That makes it particularly devastating because they did nothing wrong. To your point, just to underline it a little bit of how this happened, when you generate cryptographic keys, you need entropy. You need a random number generator to seed the key generation with randomness, which is what makes it difficult to brute force attack. And Coldcard had updated their firmware on March 17th, 2021 to add their own version of a random number generator. And it's not even that version wasn't good. They miswired it into the firmware and such that it would fail. It would never be routed through that random number generator, and it would fail silently, and it would backfall to this other crappy random number generator that has way too weak entropy to create secure keys. That means that attackers with compute that know this vulnerability can go and use that random number generator that it did end up using and compute billions of public keys, then go and private keys, seed phrases, and then derive the public keys across the whole derivation space, and then go and see if any of them have coins. And if they do, bam, submit transactions to move those coins to new locations. It's the worst type of attack. These people did not accidentally drop their hardware wallet on the ground or post their private key in a chat. They didn't even click a link, a phishing link that siphoned their MetaMask, right? Like so many that we see. I think that's what makes it particularly devastating, when compared to other hacks, all of which are devastating, but this is really not supposed to happen.
So to unpack this one, the problem here, ironically, had nothing to do with Bitcoin specifically. This was a core, like cryptography exploit where you had a poorly generated, at best, pseudo-random function to create your seeds. And as a result of that, whatever was secured with that cryptography could have been hacked. So if this had been, for instance, email provider using encryption instead, you would have been able to get into everybody's email, correct? Like this is not a problem unique to blockchains. It is a cryptography problem.
Yeah, absolutely true. And not only not a Bitcoin problem, could have been an ETH or Solana problem. And to your point, could have been, an encrypted zip file problem or any type of key generation. And the worst part is it's not even really the software and the firmware just failed to route the key gen through the random number generator. This is not the first time that we've seen random number generator problems, even in crypto, to be clear. I think one of the other things that's so astonishing, though, is how popular this hardware is. It's great hardware, to be clear. Like they also make the block clock and the open dime extremely popular Bitcoin native hardware. But this is a software development failure that somehow went unfound for 5 years. It probably was found with the help of AI. People have proven now that it's known that AIs can find it. But it didn't need AI to find. There are simply not enough eyes on this code base. There were obviously issues as well with the code base. It was not fully open source. And when you look at the code base, there's hundreds of commits right to the master branch with no comments, right? Like, so it doesn't seem like it was properly reviewed either. But just for some numbers, I'm not a software developer. I'm not an expert in cryptography. And I'm not an expert in this type of computation to derive these seeds, which is what the attack is. I am an expert in on-chain forensic tracing, and that's what I've been doing. I've been following the funds here and trying to identify victim and attacker addresses. And along with helping victims, if they reach out to me, also submitting those addresses to relevant U.S. federal government law enforcement, crypto exchanges, crypto ISACs, right? SEAL, all of the relevant cyber investigators to try to make sure that these addresses get flagged by Chainalysis and TRM Labs and Elliptic and all the exchanges so that if they do appear at a centralized intermediary, there's a chance of recovery. It's quite interesting. This started, I've got 3 defined waves, we call it wave 1, wave 2, wave 3, and a prospective wave 4, which is still sort of in the medium to high confidence. I haven't actually promoted into what I'm considering a high confidence part of the attack. That's one reason, by the way, why it's so difficult to trace, not because it's Bitcoin specifically, but because these are like thousands of previously unconnected cold storage addresses. You know, if a bridge gets hacked, we go and look at the smart contract address and we see all the funds flowing out of it and we see where they go. This to actually gather and find all the examples of people's cold storage addresses being siphoned, we basically have to rely on patterns of attacker transaction patterns and victim reports. And so wave one, which started just after midnight UTC on Thursday morning, July 30th, was really identified by victim reports around the community, and then the pattern described and identified by engineers at Block Inc., right, which Cash App, Square, the BitKey, those guys, brilliant engineers there who have their own hardware wallet, the BitKey. They identified the transaction pattern that then I extrapolated to go find the totality of wave one. I've since talked to dozens of victims who are confirmed part of wave one, and that those victim confirmations are sort of how we verify that our pattern analysis is accurate.
Hey, Alex, can I ask a question? Wave 1 through 4, same attacker, or are people piling in and saying, "Oh, I found an exploit"?
Yeah, so wave one is like a bunch of obviously seeds broken and funds transferred in bulk into one or two collector addresses and then one or two attacker holding addresses, and they're sitting there inert. Wave 2 is a very similar topography. Again, tons of confirmation from victims in waves 1 and wave 2, so we're very confident in that set. Wave 3 has a totally different topography, a very internally consistent one. So we think it's each of these wave 1 and 2 and 3, we're confident are waves. Wave 3, though, rather than siphoning many users into one big address, which is sort of what 1 and 2 do, wave 3 has one victim per vault storage by the attacker. So it's like if my 10 addresses all get siphoned in one transaction, they stop at one spot intermediary that's just for me, and then they go into one vault that's just for my funds. And so there's 293 victims, we think, and there's 293 vaults. So I don't know if 1, 2, and 3 are the same. If I had to guess, if there is any overlap, I would say 1 and 2 are probably the same. 1 and 2 comprise like 70+% of all the funds we think have been stolen. 3 has a bunch too. If 3 is the same as 1 and 2, then the attacker demonstrably changed their operational process. Wave 4 is still not totally confirmed. I don't actually have victims yet that I can confirm are in wave 4. Wave 4, I identified solely by a burst pattern. Think about the pattern we're looking for. The addresses have to have been funded and created after the firmware upgrade on March 17, 2021. They likely are dormant for a while in general because, again, these are long-term holders. They're fully swept. They're swept with a fee that typically most of these patterns have dramatically exceeded the median fee rate, right? Attackers, they'll overpay for fees to get the coins. And they have other transaction fingerprints. I saw all of that at the chain tip last night and in the mempool, and that's why I flagged that. You know, there definitely are some false positives in there. We need some victim reports to really help us confirm. The last thing I'll say, which I haven't yet really reported, but I will on X sometime tonight, there are like 14 other identifiable patterns that we have found that do not appear related to any of those waves, but do have verifiable victims identified because victims have come forth. And then I've looked at the patterns and behavior of their attackers and found several others, or at least one other, right? So more than one instance. You know, those are literally footprints A through L that I'm calling them at the moment. I think N actually now. Those have crept up the count. While we may not be able to yet extrapolate like a giant amount to each of them, they are confirmed victims. And so, you know, we've been saying, I think the last numbers we put out were near 1,400 Bitcoin yesterday at the end of wave 3. If you add the amount, you know, we're saying maybe 2 or 3, I think 300 or 400 in wave 4, but I'm not adding that yet. I really do need confirmation. And I encourage victims to DM me on X. I've been diligently helping people for several days now, not just cataloging it for us, but providing back basically fulsome Chainalysis style reports that they can use to report to authorities. But I have it now at, you know, if we include wave 4, we're almost at 2,000 Bitcoin. So we're well over $100 million of self-custodied Bitcoin. Even without Wave 4, we're over $100 million. I would place it more in the 1,600 BTC range. Again, for a distributed self-custody storage hack, that's unprecedented as far as I'm aware. Quite devastating.
That's awful. The thing that jumps out at me is that we operate in this trustless, permissionless environment, and the problem is that as trustless and permissionless as you try to be, you have to have trust somewhere, and they trusted Coldcard to do the right thing, and that's where everything broke down. And so it's really, really hard. Hopefully, there's some good things that come out of this, which you hate to even emphasize right now because it's so terrible. But, Alex, you're very much in the Bitcoin world. If a high level of compute allowed people to derive seed phrases, to me, this is a precursor to what quantum could do, not only in Bitcoin, but across, all of financial services and beyond. So maybe this is a wake-up call, for the community to really focus on these high compute threats. Do you agree with that?
I do. Of course, the threats are a little different. But they're really not that different, right? I mean, if you had substantially, industry standard entropy, you're not affected here, but you could be, because the world's GPUs combined probably couldn't break it. But that, you're talking about multiple step function increases in the case of quantum. They might be able to derive seeds across that whole space. That's the fear. I think this, you could call it a trial run, perhaps, if quantum does emerge. It wouldn't look that different, right? Because the attacker, this is one thing that's going to be tough with the recovery if it can happen. How does the victim prove their ownership, right? Like, the attackers have their keys, right? So it can't be solely by a cryptographic proof. That's why we're encouraging people to make, fulsome, formal victim filings and reports to FBI's IC3, their local police, to establish their victimhood, and keep the Coldcard device. Don't use it necessarily, but keep it, because it could be evidence that shows that you actually were the one that first had the keys. I think another point worth raising is that it's not just the cryptography or the generation of the keys that's an issue. AIs, of course, across other domains as well, are finding substantial code base issues all over the world right now. There's a red team of Bitcoin security engineers working as we speak, and for days, unfortunately forced to use like Kimi and GLM and not frontier US models, which won't allow this type of cyber work. Literally going over every hardware wallet code base, every open source library that's used in crypto and in Bitcoin fulsomely to try to patch and fight back against what is becoming an increasingly dangerous threat environment. That work is ongoing. I think you may also see that some of the coins that I've labeled as stolen may end up having actually been rescued in a white hat effort. Again, because the vulnerability is so well known, at least since Thursday, and there are quite a lot of people with compute these days at their fingertips. I hope that's the case. It's going to be messy, but I think the other one last part here, Chris, sort of goes to your question, is like, but I know the whole group here has probably thought about this, and I will say that red team has looked at the code bases for all the other major hardware wallets. None of them have this vulnerability. It doesn't mean I can't tell you they're all 100% safe, but they are not affected here. The damage to self-custody, though, because these are some of the most principled self-custody coiners. They chose Coldcard because some of them chose Coldcard over Ledger or Trezor because those two support altcoins, and they don't want those. I think one thing to know about is that Coldcard ultimately was relatively niche hardware and firmware. And if you're building cool niche hardware, like, you better be using widely adopted open source software for the firmware. I think that this is where the bug was introduced, was when CoinKite basically rejected some of the open source software and started building their own. So I think this can damage the narrative at a minimum for self-custody, for at least, among the most ardent people. and push more into ETFs and on exchanges. You've seen one of the largest flows of, off exchange Bitcoin back into exchange. I saw 22,000 Bitcoin, Sani from Time Chain Index posted since Friday. And CryptoQuant said the largest influx of sub 1 BTC transfers into exchange over I don't know how many years, right? People are fleeing. It's the opposite of FTX. They're fleeing from self-custody into exchange. So that's going to have repercussions over the long term as well.
Yeah, I even saw Munib, founder of Stacks, talking about, hey, diversify your custody, you go into ETFs. It feels to me like we're in this max period of AI threat, but I don't know about you guys. I think AI over the medium term is going to be actually very, very good for security once we get through this little hump. Because once these vulnerabilities are solved, they're solved. And I feel like, I was watching Face the Nation today, like big political, I was watching yesterday, big political show, obviously, and they had the founder of Hugging Face on, and he made this point, despite the fact that rogue agent started going nuts, he's like, AI is going to be the biggest asset for DeFi long term. We just got to get over this hump, is my take. And
Well,
I think that's right.
So let me ask, I know, Alex, you have some views on this. I suspect Ram will have some views on this as well. In the current state of AI, is it being more or less helpful for attackers versus defenders? Because one thing I've been observing and had a few people talking to me about today is, ironically, some of the guardrail training on some of the US AIs are actually frustrating the efforts of defenders in this case. Alex, what have you been seeing there?
That's absolutely right. I can tell you the red teams that are literally objectively evaluating these code bases, they're not trying to create exploits, right? But they're doing, I understand how, an objective robot clanker mind might think that it is. Like, I get that. They're all using Kimi and GLM, literally open source Chinese models. The frontier models are not available to them. Even when I traverse my own Bitcoin analytics stack, I'm not going out onto the web, right? I have a 3.7 billion row, 1.7 terabyte Postgres database of every coin's movement in the history of Bitcoin, every change to the entire state. And I ask, Claude Fable 5 to go and, pull some data from me. Half the time I get safeguarded, right? Just to look at my own data on my local machine, right? So, and this is to your point about the Hugging Face CEO, this is exactly the same thing that they faced when the OpenAI lab leak happened. So I don't have a great policy answer to this at the moment. I just know that on its face, it's absurd that American, companies and victims are having to rely on Chinese AI models. It's insane.
Yes.
Well, just on your policy point, I think the line between defender and attacker needs to change as well. Like, I've been pushing this for how many years now? We need to go on offense. And the thing about Clarity, which is making me crazy right now, is that there is a rewards for justice program. Finally, we can permission white hackers to go on an attack, going back to the early days of our Constitution and privateering. We have to have a much better policy response. Like, people cannot, this is illegal. This is like no difference in someone going to your house and stealing your car or robbing your house. And like, just because it's crypto doesn't make it any better. So we do need a much better policy response across the board. Ram?
Well, I like, Austin, the way you pose that question is super interesting. Like, does technology favor the attack or the defense? Most of the history of technology is that it favors the attacker. You've seen this with Stuxnet and Iran. You've seen this with the development of aircraft. So many forms of technology favored the attacker. The defense that you have to cover is simply too broad. The fact that the United States has two oceans on both sides has been an incredible benefit. There's just too much to protect and defend and insulate and inoculate. So it goes towards the offense. It is a shame that we don't have an open source American model yet. China's got several and they're impressive, and the VCs don't want to fund an American open source model, which I also can't blame them. I can't blame them for that. Where's the value capture around open source?
I mean, this is one of those, what's the right way to say this, is it's a public-private coordination problem. Open source models are in many ways a public good. a little bit like a park. Everybody benefits from them, but nobody individually has much incentive to fund one unless it's purely charitable giving. I think China having to play from behind on the hardware and original development front took a very different approach here, because now you're playing like a, call it multipolar competitive threat game, which is very different than just looking inward and figuring out what you'd fund. I feel like an open weight model is the sort of thing the government should be looking at. You know, Department of Defense, this seems like a pretty mainstream DARPA sort of thing. There are definitely levers that we could have to pull, but we are just not doing it in the United States. And like even today, as I wanted to get up to speed just to have this discussion with Alex for our segment, Claude is guardrailing me and I end up using Quen. What does that really say? Like, I'm an American citizen here, guys, right? Is this not the circularity? So, Alex, I want to come all the way back around to a point you made at the start, because for me, this is probably the hardest part of where this goes. And I'm curious about everybody's views here. I don't have a good answer on the self-custody thing right now. Like if my mother, if my father, if my friends are asking me, what does this mean? How could I have protected myself? My answer is, I don't have an answer for you. And I think demonstrably, especially after this hack, right? I agree with your commentary on Eric talking about tokenized stocks, but as of yet, the track record of things in MPC institutional custody at regulated places is significantly better than self-custodied funds. So what does that say going forward for Bitcoin with where we are?
Yeah, I mean, most of the time that people lose self-custodied funds, it's because of phishing attacks on them or their own mistakes. And I do think, there's that old, would you have your grandma use a hardware wallet or just tell her to open a Coinbase account? I think most people really truly would have them open the Coinbase account for, or get the BitKey, which I think was the first hardware wallet I ever even considered suggesting to older family members. I will say that multi-sig collaborative custody in Bitcoin, like provided by Casa, Onchain, Nunchuck, Liana Wallet, Anchor Watch, others, remains incredibly secure, and there is support to help you use it. Because it diversifies among many hardware wallets. Not really that complicated. Still probably too complicated for grandma. But I think, so it is possible. It still is possible. I'm like Jordan Belfort, like we're not effing leaving yet from the self-custody train. I know I'm not. But it is very problematic. And I think, you've already seen an enormous amount of coins flow into the ETFs and, let alone MSTR and people getting exposure through centralized means. And that's fine. I think there's been a wing of the Bitcoin community that is, looked down upon those people like with a purist mindset as if they're not, true Bitcoiners. And, they might not be as much a Bitcoiner as you if you're rolling 100 dice to introduce your own entropy into your Coldcard, MK5. But that's okay. That is okay. This is your money. If you don't feel strong that you have the education and training to do self-custody, don't feel bad about that. I think it's totally fine. I use river.com all the time as a Bitcoin exchange. It's a great Bitcoin brokerage. I've got accounts at most of the big exchanges and custodians. I bought and held Bitcoin at Fidelity Digital Assets. I own ETFs, right? So like all of that is fine. I think in the near and medium term, you absolutely are going to continue to see people move towards those. And I agree. Look, they have a checkered history, crypto exchanges, of catastrophic failure. But again, it's sort of like the nuclear power plant thing. Was Chernobyl a nuclear power plant thing, or was that Soviet mismanagement? Was FTX fundamentally like a crypto exchange thing, or was that a criminal named Sam Bankman-Fried? Right? I do think with strong regulation and oversight and industry standards, centralized intermediaries can be very safe and are demonstrably very safe.
I have to pile in on the regulated front. The one area where FTX had a truly regulated subsidiary, which is FTX Japan, they didn't lose any money. Right.
US too.
LedgerX too.
Same in the US.
LedgerX. That's a great call. And by the way, on the ETF front, like Chris, I'm just shooting from the hip here, but EasyBC, do you know anything about that thing?
I don't want to talk about specific products that we may or may not
No,
offer,
but I was going to make the point, like, have you lost any Bitcoin to this hack? No.
Personally, no.
No, well, no, Franklin, right?
No,
like,
no.
Yeah.
So, like, I think the point is, and I think Eric Baltunis made it. Look, we said this over and again. You shouldn't be forced to use an intermediary. I think we all agree on that.
Yes.
But I think we also agree that intermediaries do deliver certain value, and there's going to continue to be a desire to use intermediaries by certain parts, probably the preponderance of the population, because you get value added services. And so, like, DeFi maxis can be DeFi maxis, but remember, like, what did we learn? You're still placing trust in something or somebody, even if you're trying to be, self-custody. You're trusting that software. You're trusting that provider. I tend to hope that Alex is right, and these NPC players are secure, but you're trusting them. So, you have to choose at the end of the day, who do you want to trust? Do you want to trust an intermediary that's well capitalized? Do you want to choose an intermediary that's insured or not? And I think we all agree on this, because we've been in this space for so long. The government shouldn't tell you what to do. You should make that choice, and it should be an informed choice.
Yeah, I totally agree. And it's not just like the random number generator in this hardware wallet. Like you are making different trust assumptions depending on how and where you store your coins, right? Like it's true that at a centralized intermediary, they could have a catastrophic failure. It's also true that even if the random number generation and key generation in a hardware wallet's great, they could have a different error, right? So, I mean, this is one reason why me personally, and I'm not in the business of recommending ways to store Bitcoin, but I like the multi-sig collaborative custody where I hold some keys, a vendor that I pay holds some other keys, and that gives me some peace of mind. I can lose a key or two of mine, or they can go away and I can restore. They can't, right? To me, and by the way, this is, I think, as we know, this fundamentally is the way that regulated custodians basically also store, which is with multi-distributed, multi-sig setups. That those are available to individuals. They still may be too difficult for you, and that's okay.
Last point, if I just make one more point. So we're in this institutional age of crypto. And when you unpack the institutional mindset, it really comes down to one thing. I want a throat to choke. I want to be able to sue somebody. That's what they'll tell you over and over again. I don't care. Like, I need somebody who's capitalized that I can sue. And I think there's value in that for many institutions. So that's my last point about this segment.
Yeah, there are not institutions that are single sig cold card custody.
Well,
that is not a thing.
We hope not.
And very few, I would say, Fidelity and Coinbase, I think, are and maybe, I guess BitGo doesn't have an ETF. Fidelity and Coinbase, I think, are the only two ETF, because, Coinbase doesn't have one either.
Gemini.
Well, they don't have an ETF, though. I guess Fidelity is, I think, maybe the only ETF that is self-custodying. But of course, they themselves are an institutional custodian using all the sort of same principles as the coin. So most are, and I think at this point, many, if not most of the major Bitcoin ETFs in the US are using multiple custodians for this reason. Again, so everyone's sort of making that same point. And I think, again, I typically do not go to, defined contribution or defined benefit plans or high net worth individuals or liquid funds or family offices and suggest even that they self-custody coins, right? We're all suggesting qualified institutional custodians.
So another point that I would like to make here, because I've given this advice to my students actually about US regular way bank accounts, is the only free lunch in finance is diversification. And what I mean by that is always have multiply redundant options. Don't leave your stuff in one place, because things that have nothing to do with you can break your shit if you do that. If you only have one bank account and your bank goes bankrupt, or something gets hacked, or there's some sort of fraud that you had nothing to do with, which totally happens due to things like account compromise, all your money can get bricked until that gets fixed. You should always have a backup plan. It's probably not a bad idea to extend that thinking into crypto, right? Like, everybody, you're going to need to decide on your own personal situation, but I do not have all my Bitcoin in like one single ETF. I have it spread out amongst them for exactly this reason.
Yeah, I think Giannis not going to try his last name, the NBA superstar,
Giannis
from Greece,
Antetokounmpo.
right? Thank you. He said in an interview once that he has his literal cash in American banks spread across like 50 banks.
Yeah.
Now, he comes from a unique, Greece has a unique history with banking and haircuts, right? Like, the Cyprus haircuts are literally why like the Winklevoss twins got excited about Bitcoin. So, I mean, that's an extreme example, right? But I agree. I think it's great advice, Austin.
All right. So final point on something that requires trust before we run out of time, the Fed. So FOMC kept rates at 3.5 to 3.75. The vote was 9-3 with 3 people dissenting. Kashkari spoke publicly about his, saying, data center investments have added a new demand element to inflation. I would rather tighten policy incrementally as we gather more data. The long end's not thrilled here. It's pushed up into the 4.7s at the 10-year point, as I talked about. We're going to pretend the 30-year is not looking even worse. And Lynn Alden said, bond bulls don't make arguments for why deflation is coming anymore. They just look at Warsh like this now, and included the amazing meme from the whale. So, Alex, while we've got you here, I know you talk to your friends at Galaxy about this frequently on your own podcast, but what are you making of the rates environment?
Oh man, it's the market. They're letting the market try to do it for them. I think there is no more Fed put, right? I mean, that's sort of the obvious empirical consensus. And are we in an era now of? I mean, I'm starting to feel like this is a parliament at the Fed voting, with many different ideas. I think it's a very uncertain rate environment, is the simplest way to say it. I declined not just for this reason. At the end of last year, I said I was refusing to make a Bitcoin price call for this year. I'm quite happy I did refuse, I have to say. I said it was a very uncertain investing environment, not just because of AI, or macro, or the Bitcoin drawdown and the crypto bear market, but also because of rates. And to me, I'm an observer, but a relatively novice one. But I don't know what to say here exactly. And did you see Scott Bessent's photo of the buying JPY? And Trump said on Air Force One that why are we doing? We really love the Japanese. They've been really great to us, except for that one time about Pearl Harbor. He had to throw
and we're selling the euro too, right?
Yeah. I mean, I think it's a very tricky environment, and so far, looks like we're kind of getting less information from Warsh, as now is pretty clearly expected, than what we're used to, and so the market has to react on its own. Well, it may be healthy. I mean, ultimately, that may be a healthy option here. I tend to lean free market, and I mean, I'm a Bitcoiner. I would say my sort of base position is to be a critic of the Federal Reserve. I think that this is, in some ways, although not necessarily the ones that matter to your pocketbook right now, a little bit healthy to have the market sort of drive the rates a little bit more than the Fed. But again, I'm not an expert in that. That's just my sort of sense.
And for years, the yen carry trade really was one of the foundational parts of markets. We saw it, get shocked some months back. We saw markets puke because of it. I'm just hopeful now that traders are realizing that that's not here to stay forever, and that they'll adjust. That said, the Secretary of the Treasury wants to keep rates low. It's very much on his mind. We're also seeing more power move from the Fed to the Treasury. We've known this. And look, if there's anyone who understands currency markets, and it's our current Secretary of the Treasury. He was on board when they broke Bank of England. So I think he knows what he's doing. Let's see how he plays it out. But it's how do you keep rates low? How do you stabilize and not shock markets through an abrupt unwind of the carry trade? And how do we stay onwards and upwards?
I like Kevin Warsh's message of creating accountability for the Fed. He is right to point out that the Fed has missed its end rate. We've been well above 2% for over 5 years. So he's saying the right things, but he's not really cutting rates. The bond market's doing the work itself on the long end of the curve. On forward guidance, we'll have to see how this plays out. This element, I'm not sure, right? Because you may have other Fed members that being undue influence if Kevin Warsh provides less feedback, right? The market's going to make a reaction function for the Fed anyway, even if it's imperfect. What used to happen before forward guidance, I remember this distinctly, we'd go to these conferences, there'd be some connected party that knows someone at the Fed or in the FOMC, and everyone would gather around the fireplace and they would tell the story about how they're reading the tea leaves. It's kind of similar to the world before Reg FD. Before the Reg FD, buy-side investors would have access to sell-side analysts and could front and run research and exploit, take advantage of that. So it's good that we have Reg FD here today because it creates the field.
All right.
The risk now is that people with privileged access have an advantage over other investors.
So, Ram, thank you for closing us out. I've got to stop us here because we have a couple of hard halts at 5:30 today. So for everybody listening, remember to subscribe to the new channels. Thanks for joining us for this episode of Bits and Bips. Special thanks to Alex for joining us to discuss these topics today. We appreciate it, man. And for everybody else, we'll be back in 1 week to discuss more about how the worlds of crypto and macro are colliding. Until then, thank you for watching and hope you enjoyed this episode of Bits and Bips. Just remember, nothing we say here is investment advice, and please check unchainedcrypto.com/bitsandbips for more disclosures.